Everything in this video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie, and let's take a look at the midweek market update. Happy New Year to you. Here's to a kinder 2023, at least in the digital asset industry, as we've seen our fair share of negative news and headlines in 2022. The first bit of business is always macro, and as for the past many months, we've been focused on inflation, specifically the CPI print, because of rates and how that affects the risk-on mentality generally. So what I have here is CPI prints previously. The next one is due this Thursday, as well as current rates, rate probabilities, and trueflation, which is a measure of millions of items every day reported to Chainlink, and it gives us an idea of year-over-year data real time, which is rather useful and has been over the past 6 months. So based on trueflation as well as other estimates in the TradFi space, the expectation is a decline in the month over month for CPI. So although we may be winning the battle, it doesn't look like we've won the war just yet on inflation, as 5 and change is still far too high. And this week we've seen continued language from the Fed regarding leaving rates higher for longer, stepping down on the rate hikes from 50 to 25. So there's a little bit of an if this then that situation coming up this week, where if you're under the assumption that CPI will be down month over month, then there's a high likelihood that the Fed will continue to hike, but hike at a 25 clip instead of a 50 basis point clip. And then how will the market react to that? Now, is that priced in at this point? Is that sort of expected? And then the flip side is if CPI comes in hot, which it shouldn't come in hot based on the available data, but if it does, do we just melt out in panic mode because that means a 50 or a 75 as opposed to a 25? So we'll see over the next couple of days, but the consensus is certainly a decline in the month over month number. And we can see that from various outlets over the past couple of days. This is US News with the headline, somewhat confusing, inflation on the run, meaning we're beating inflation or we are fixing the inflation problem. And we also have the San Francisco Fed leader mentioning slower rate raises in the future. So we continue to have hawkish members of the Fed who say we need to keep rates above 5, maybe go to 6 for a very long time. We have some doves slowly coming out of the woodwork here saying, let's slow it down. Let's let this policy take into effect. We'll see who wins out at the end of the day. Probably the hawks, but the political pressure will mount should inflation continue to decline. And this is probably stating the obvious, but again, the CPI print will help with the Fed's decision, and I'm sure they have some sort of data behind their verbiage already written up for the meeting at the end of the month. So they certainly have some time to digest the number and the details of core versus CPI and everything in between. Now, if we look at the trueflation data, like I said, although we are winning the battle, it is a bit problematic here that we've flattened out. Maybe this is a holiday effect. Maybe this is a winter effect. We flattened out here on the decline, the descent. The month over month data had been pretty consistently decreasing. But as of late, really late December, we've been stuck at this 575 level. And at that point, that's when it becomes challenging, I think, for the Fed when inflation doesn't come down and they keep raising rates. How long do they keep raising at 25? How long do they hold the rates? Do they hold the rates out to the end of the year, right? I don't think they've given us any specific forward guidance, but these are all the things people are going to be thinking about. Probably not this month, but more specifically within the next 2 or 3 months when those prints come out in succession and there isn't an improvement in inflation. At least that's the expectation based on this data. That could be incorrect, obviously. But when we get the January number in February and it's only slightly down from December, and when we get the February number in March and it's flat compared to February, we might be in for a bit of a problem, in for a bit of a rough patch heading into Q2 based on the macro expectations of rates. Flipping gears to some technicals, now that we have some interesting things to talk about here. Zooming way out on Bitcoin since 2012, we can look at a few things. We can look at the 20-week moving average, which is this yellow line here. Kind of hard to see, I know. This green line here, which is the 200-week moving average. And then we can look at this band between the 2-year moving average and 5 times the 2-year moving average. The white line is just the midpoint between the two. And no matter how you try to slice this, we are certainly below anything that makes sense, anything that's important historically as far as support resistance. The 200-week moving average had been extremely important historically. It held up through COVID. It held up through 2015, 2016, 2018, 2019. Didn't seem to matter over the past 6 months. So we're still below that. The 20-week moving average, which historically has been incredibly important for trend determination, we've also been below since the beginning of last year, since the beginning of 2022. So all these levels give you a little bit of an indication of where price needs to be in order for things to switch gears from bearish to bullish. Let's say we get back above the 200, back above the 20-week, back above the 2-year moving average, which at this point is at around 37.5. So we could have a ton of activity from, let's say, 16 to 33 and just be flat, like we were in 2015, 2016, even 2018, 2019 to some degree. We can have a pretty intense mean reversion and still hold essentially a neutral trend. So we've got a ways to go on that front, certainly. The reason the halvings are important is because this is the time when issuance declines by half. The next halving is in 2024, and you can generally see the halving effect, whether that be psychological or whether that be simple supply demand. Arguments to be made for both of those cases. But prior to halving, generally it's been more choppy, more neutral, less exciting than post halving. So we've still got a ways to go. We're around 450 days away from the next halving. Now, ideally, what we want to be seeing here is utility, because that ultimately will drive adoption, use. That's the healthiest thing. We don't want to be waiting for every halving cycle, hoping that something happens. But here's where we sit relative to the next halving today. If we zoom in a little bit and we look at the 200-day moving average in the yellow there, as well as this trend channel known as a pitchfork, pick 3 points to get a rate of change. Price likes to live generally in the midpoint if it's sort of obeying this trend channel, which it appears as though it has been. And it also acts as an oscillator for overbought, oversold, with the assumption that this trend channel will hold. Now, there's an argument to be made once we get back above the black here that the trend has flipped when we go from the bearish trend channel to a more bullish scenario. Now, typically we go from bearish to neutral to bullish. It's not typically a complete about face. And that's when you start to see us drift out of the pitchfork. And we've certainly got plenty of time for that to happen. Sometime in and around Q2, certainly a possibility. Realistically, Q4 this year makes the most sense to me. And all the while, the entire year here, we just sort of chop around for a good bit until there's a clear path on inflation and rates and some understanding of what's to come down the line. So still bearish based on that, certainly, but those are important levels to watch that we're watching over the next few weeks and months. Another trend determiner that historically has done extremely well is the Ichimoku cloud. And if you're wondering, does TA work on digital assets? It behaves incredibly well for digital assets, partially because they're very hard to price appropriately, and many people just rely on technical analysis. So currently, much like the 20-week moving average, we've been below the trend determiner of the cloud itself since the end of 2022. 2021. You can see in November, we hinted at bearishness, and we've essentially held that the entire year previous. And we are approaching an attempt at a trend reversal here. Again, we want to be above the cloud. Somewhere around 19 would probably do it. But this also has time. Now, the good news is on lower time frames over the past few months since November, we've been setting up for what's known as an Adam and Eve double bottom, a V and a U. You see these over and over again in many different forms. You can even see one potentially right here that didn't actually play out. This is one of the reasons why these patterns, specifically the trade probabilities increase for expectations once price is above the resistance level, in this case 18,000. In this case, it would have been around 25,000, which price never got to before FTX collapsed and brought the market down with it. This is a much more reasonable trade to play out in the near term. Anything above 18, this suggests that based on fib extensions, levels to watch would be 19.5 to 20.5. And even if this doesn't play out, which we've sort of seen before, interestingly enough, on the Adam and Eve, the Eve is typically, at least in digital assets, not as deep as the Adam. But we've seen this before. This is on a longer time scale, but this is 2018, 2019, where we had months and months of low volatility, flat. Then we had some tether concerns. We had a Bitcoin fork civil war. And we also had legacy collapsing at that time in November 2018. So all that stuff didn't help us, and away down we went. But after we did form somewhat of a bottom at that time, a very similar idea emerged where we had this possibility for this Adam and Eve setup with the exact same rationale for targets. And what ended up playing out was a bit of a fake out at resistance when we hit that 4,000 level. And we ended up forming more of an ascending triangle than an Adam and Eve. But the most important part here was we never really made a lower low. You know, we broke down at resistance, but ultimately the lows held. We continued to make higher highs. So if the Adam and Eve does fail this time, what you really want to see for this trade to play out as expected in the near term is an additional series of higher lows as opposed to any new lower low. And also worth noting, it did reach the expected level based on those fib extensions, paused for a little bit, and then had a significant run beyond that. Not certainly something I'm expecting this go around, but I do like where we sit on this Adam and Eve setup. ETH, very similar rationale, almost the exact same read, sits within a bearish trend channel, has been essentially below the cloud the entirety of 2022, below the 200-day moving average. Now it has a lot less wiggle room to flip bullish. It can flip bullish pretty easily above 1,500 based on these trend metrics. So what we are more likely to see is ETH to actually drag BTC with it, as opposed to BTC leading everything else. I mean, we've already seen rather extreme mean reversions in a dozen or so altcoins over the past week, with Solana being up 65% in the past week after it was down 90% over the past year. So although Bitcoin is quiet and volatility is at historic lows, the rest of the market has seen some pretty crazy moves over the past week to start the year. So for ETH, again, anything above that 1,500 level in and around March, before March, throughout February, certainly would change the attitude of trend metrics here. And ETH as well on the lower timeframes has this very similar Adam and Eve type of setup, this V, this U, this double bottom, whatever you want to call it. ETH has had a series of chart patterns that have, for the most part, played out as expected. We had mass deleveraging, we had the ETH proof of stake transition, which thus far has not panned out in a bullish fashion. We had FTX explode, right? So I do expect this to play out based on the Adam and Eve setup. And again, even if that fails, there's a potential for this ascending triangle setup so long as we don't make lower lows. And ETH has really followed TA quite well over the past year, even with all of this headline event driven volatility, inverted head and shoulders, right? These are reversals that you expect play out as they did, descending triangle. So it's not out of the question here to see ETH push potentially 1,500 plus within the next couple weeks. And that leads to an ETH BTC conversation, which for some people who aren't familiar with digital assets, maybe aren't aware that pairs like this exist, but originally there weren't fiat pairs for most coins. So all altcoins were denominated in BTC. That changed a little bit once Tether got introduced in 2014, changed even more when we saw more USD in on-ramps for exchanges. Nevertheless, pairs like this still exist and are traded heavily. And ETH BTC has never been up here at this level, 0.08. And just measuring out the fibs here, there's an expectation for a test of 0.11 to 0.12. Certainly be reasonable within the next 6 months. And along those lines, things to think about with the ETH BTC pair. Mt. Gox coins, which were locked up in 2014 when that exchange sort of went belly up and closed withdrawals, are finally potentially being sent to users this year. Now they keep moving this repayment registration deadline back and back and back. Lump sum payments, immediate repayment. Like there's going to be so many different tiers of what's going on here and where it's going and all this stuff. The good news is we can see all it moving on chain. We are going to be able to tell where it's going. Most of these are going to be going to Kraken because that's where the creditor portal is functioning, at least for the US individuals. So it's not going to be a secret when all this happens. It's going to be very visible. There's going to be tons of news and headlines about this. But this does represent a supply unlock. This is only 162,000 coins, but it is a supply unlock. Also to consider, Ethereum has a similar supply unlock. Now they have over 10% of the coins currently locked in the proof of stake mechanism. And I think it's decent to sort of game out that most of the Mt. Gox coins will probably be sold because they're up a significant percentage relative to 2014. Whereas these Ethereum coins, what's most likely to happen, which makes the most sense, beyond 32 ETH in a validator, you don't make additional yield for your stake. So what's likely to happen is anything above 32 ETH per validator will get harvested. It might get sold. It might get rolled into a new validator, but they haven't even established a date for those withdrawals yet out of the protocol. So they're in the early stages there. So there is this window between Mt. Gox coin distribution, ETH proof of stake withdrawals, and Bitcoin halving in 2024, where the ETH BTC price could jump violently up and down, dependent on all those things. Some food for thought in the beginning of the year here. That's all I have for this one. This video is for informational purposes only, and the opinions are expressed are not financial or investment advice. All opinions are my own and do not reflect the opinions of Valkyrie Investments and its affiliates. No fiduciary obligation or duty exists or is created between you and Valkyrie Investments or its affiliates, including me, by virtue of any opinions expressed in this video.